Nokia stock closed the regular trading session on Friday, May 8, 2026 at exactly $12.35, marking a significant upward move of 3.81% for the day. While the official market is currently closed, the momentum did not vanish once the bell rang, with the after-hours price hovering around $12.27 as of 8 p.m. Eastern Time. This minor pullback in extended trading is often just noise after a sharp daily rally, but for Nokia stock, it tells a much deeper story about the gap between what most people expect from this legacy brand and the cold, hard reality of its current balance sheet. Most investors still look at Nokia and see a 90s cell phone giant that lost its way, a company that is forever playing catch-up to the heavy hitters. But the reality that just hit the tape is far more aggressive. We are seeing a massive surge in institutional activity, specifically tied to their new AI-native network reorganization. If you are looking at the standard charts on Reddit or checking your Fidelity brokerage account, you might just see a telecom firm. But the sophisticated players using interactive brokers trading platforms are noticing something else entirely: a book-to-bill ratio that has exploded past 1.0, specifically in their optical and cloud segments. This means Nokia is currently taking in orders faster than they can fulfill them, a high-class problem that usually precedes a major valuation re-rating. The expectation was that Nokia would be a slow-growth utility play, a safe but boring place to park capital in a Schwab Intelligent Portfolios account. Reality, however, has delivered a 31% earnings beat in the most recent quarter. While retail investors were distracted by the latest shiny object in the Silicon Valley circle, Nokia quietly integrated Infinera ahead of schedule and started eating market share in the U.S. Department of War's 5G infrastructure projects. This is not the Nokia of your childhood. It is a critical infrastructure backbone for the next decade of defense and data center expansion. If you are doing your own online investing or seeking investment help, you have likely heard the narrative that the 5G rollout is over and the growth is gone. That is the expectation. The reality is that the 5G cycle is shifting from basic coverage to high-capacity AI-driven edge computing, and Nokia is positioned right at the center of that transition. We saw over 66 million options contracts change hands this week, a level of volume that suggests a massive shift in how the big money views this ticker. When you see that kind of liquidity flowing through a Fidelity trading platform or a professional interactive broker's account, you know the narrative is shifting from legacy telecom to AI infrastructure play. Speaking of moving capital, I want to hear from you. Comment below how many shares of Nokia stock you currently hold in your portfolio, or if you think the recent move is just a temporary spike before a larger correction. It is easy to get caught up in the daily noise of Robinhood stock trading or the rapid-fire updates on the Robinhood app, but the institutional shift here is undeniable. Firms are looking for value in a market that feels increasingly overextended. When you look at the PE ratios of the major AI darlings, they are astronomical. Nokia, despite its recent run, still offers a different valuation profile that appeals to those focusing on self-investing and long-term wealth management. They have managed to expand their gross margins by 320 basis points in a single year. That doesn't happen by accident. It happens because they are high-grading their revenue, moving away from low-margin hardware and towards high-margin software and licensing. For those using SoFi Investing or the SoFi trading platform, the appeal here is the combination of a turnaround story and a growth engine. The company has essentially split itself into two distinct worlds: the cash cow mobile infrastructure segment and the high-growth network infrastructure segment. The latter is growing its addressable market at a 27% compound annual rate. That is the kind of math that forces analysts to tear up their old reports and start from scratch. Let's look closer at the trading mechanics we've seen over the last few sessions. The stock has been bouncing between a 52-week low of $4 and a high of $13.98, and we are currently sitting right near that upper resistance level. A lot of the selling we saw in the after-hour session at 12:27 is likely just profit-taking from traders who got in early and are using their Robinhood investments to lock in gains. But for the serious investor using Fidelity Wealth Management or individual brokerage accounts for core holdings, the focus remains on the structural changes. Nokia is no longer just selling boxes. They are selling the intelligence that runs the boxes. Their partnership with nvidia for airan technology is a perfect example of this. It's a move that aligns them with the most powerful trend in tech without requiring them to trade at the same insane multiples as the chip makers. This is the pick and shovel play of the 2026 market. While everyone else is fighting over the gold, Nokia is building the roads that the gold miners have to use to get to work. It's a classic expectation versus reality play. The market expects a commodity hardware provider, but reality is revealing a high-tech infrastructure monopoly in specific high-growth niches. Now, we have to talk about the risks, because no investment is a straight line up. The broader macroeconomic environment is still heavy with pressure. High interest rates have made it more expensive for telecom carriers to upgrade their equipment, which could slow down Nokia sales cycles. If you are using investing sites to track global capex, you'll see that the big carriers are being cautious. However, the reality is that they don't have much of a choice. If they don't upgrade to AI native networks, they will be left behind by competitors who can offer more efficient, lower latency services. This creates a forced buying cycle that benefits Nokia. Even if you're just getting started with online investing strategies or looking at SoFi ETFs, understanding this forced upgrade cycle is key. The demand isn't just coming from traditional telecoms either. It's coming from hyperscalers like Google and Microsoft, who need Nokia's optical networking tech to connect their massive AI clusters. This is a massive diversification of their customer base that the market hasn't fully priced in yet. For those managing their own portfolios through a Fidelity mobile app or an interactive brokers platform, the technical setup here is fascinating. We've seen a steady climb supported by increasing volume, which is usually a sign of institutional accumulation. When big funds start moving into a stock like this, they don't do it all at once. They build positions over weeks and months. This creates a floor under the price that retail traders on the Robinhood app often miss. The expectation is that the stock will stay in its historical range, but the reality is that the floor is moving higher. We are seeing a consolidation phase right now, and how the stock handles the $13 level will be the tell for the next leg of this move. If it breaks through and stays there, the next target is that 52-week high, and beyond that, we are in blue sky territory. The business model has been through a grueling transformation. Nokia spent years cutting costs, divesting non-core assets, and pouring billions into R&D for 5G and 6G. They've essentially been in a defensive crouch for half a decade, but 2026 is the year they finally stood up. Their licensing business, which includes a massive portfolio of essential patents, provides a high margin floor to their earnings that many other tech companies would kill for. When you combine that stable income with the explosive growth of their AI and cloud segment, which grew 49% recently, you get a very interesting hybrid. It's why people are looking at Fidelity IRAs or intelligent portfolio options to get exposure to this kind of balanced growth. It's not just a speculative bet on a meme stock. It's a calculated position in a company that has proven it can survive the worst and come out leaner. Looking ahead, the catalysts are clear. We have the continued integration of Infinera, which is expected to drive even more synergies and margin expansion. We have the potential for more large-scale government contracts as countries look to secure their communication infrastructure with trusted Western partners. And we have the ongoing 6G development, where Nokia is already taking a leadership role in setting global standards. The tension between the old perception of Nokia and the new reality of its market position is where the opportunity lies. If you are using Robinhood fractional shares to build a position, or managing a complex portfolio through interactive brokers, you have to decide if you believe the legacy narrative or the new data points. The numbers don't lie. Higher margins, better earnings, and a growing backlog of high-tech orders. In the end, the story of Nokia stock in 2026 is one of a giant that successfully reinvented itself while the world wasn't looking. The expectation was a slow decline into irrelevance. The reality is a high-stakes pivot into the most important technologies of the decade. We saw it in the 3.81% jump today to $12.35, and we see it in the institutional money flowing through Fidelity ETFs and professional trading desks. The market is finally waking up to the fact that the backbone of the AI era isn't just built on chips, but on the networks that connect them. Nokia has positioned itself as the essential architect of those networks. Whether you are using a SoFi robo-advisor or making active trades on the Robinhood app, this is a ticker that demands your attention, not for what it was, but for what it has become. The contrast between the outdated public image and the modern financial performance is a textbook example of a valuation gap waiting to be closed. As the market reopens on Monday, all eyes will be on whether that 1235 close was just a peak or the start of a much longer ascent into a new tier of tech leadership. The authority with which they are executing their new strategy suggests that the reality of their success is only just beginning to catch up to the market's expectations. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends. Bell subscribe for more updates.